Markus, thanks for coming in. Let's just have a quick reaction to some of these comments coming through. Cascading default we have when you look at Europe, the solutions are not going to be implemented any time. This coming from a fund manager saying that means the market volatility is going to continue.
Yeah, I mean, in terms of the volatility, it's here to stay until people come, or at least Europe comes up with a program that people think is credible. In the meantime, what you've got is equity markets that are already cheap, just getting cheaper and cheaper. So from a value point of view, and if you had 12 months, which sadly very few of our clients seem to have these days, you'd be a buyer. But otherwise, for the moment, everyone's just watching to Europe. If they do something, fear. If they do something good, if they do nothing, well, then we'll go down again.
Well, we have, till the Cannes meeting in the beginning of November 3rd, I believe it is, and George Osborne, the UK Chancellor of the Exchequer, saying that, well, we've got 6 weeks, but will the markets give them 6 weeks? That's the thing.
Well, not at the current rate of decline. You haven't got 6 weeks effectively. You've got a couple of weeks to come out with something. So 6 weeks would be nice, but I doubt the market will give you 6 weeks.
All right, well, we've got these dire warnings, as I've just been mentioning, but, some of the policy responses about ring-fencing Greece. Can they really? And does ring-fencing mean, OK, we're going to default, we can't say it yet, but it's going to be trying and get an orderly default in place?
Yeah, I mean, if you put up enough money, you can ring-fence anything. And obviously, the investors that are betting against the ability of the euro to continue will kind of step away. So, yes, you can, but you've got to come up with a plan. And a plan which is, fully embracing every possibility. And for the moment, that's just not happened. So that's why the market keeps having to go at one or the other. And as long as that's the case, volatility is with us.
Yeah, as you also said just before we came on air, you said the amount we've lost in the equity markets in terms of value could have sorted this problem out.
Correct. So, it's like with most issues, if you've got a toothache, you go to the dentist straight away, you don't leave it for months and years until it really becomes a root canal. And that's kind of what the politicians have been doing. So sadly, until they come up with something better, that's where we're going.
Right, but we followed what's happened in Europe and the US here in Asia. We followed them down as well. I mean, that's just the linkages we have in global financial markets. But is there a point when that stops and we start looking at the fundamentals here as opposed to what's going on over there?
Well, I mean, the fundamentals here are better than they are in Europe. And so even now, if you look at where equity prices are, what they're implying earnings to go down about 25 to 30%. So from an Asian point of view, that would assume it's another recession in the making. Now, our earnings going to go down 25, 30%? Probably not, but that's kind of what we're pricing in. So you'd like to see equity markets move on fundamentals, but what you've got is very high correlations at the index levels. So if Europe goes down, Asia goes down. If the US goes down, we go down as well.
Try to stay clear of equities. I mean, is it just too dangerous to be holding stock?
Well, I think for investors that are running it on a 1 week or 2 week basis, the best thing to probably do is be in cash. But if you've got a year or more in terms of your investment horizon, you're getting equities very, very cheap in this part of the world. They're implying next to no growth to perpetuity. And whether you look at price to books or EV to EBITDAs, again, 80% of the time buying at this level has made you money. So it just depends time horizon.
Any particular industry group you'd be looking at?
Well, the ones that are implying the lowest earnings growth is the likes of the banks and real estate as well as some of the industrials.
You touch property?
Yeah, I mean, if you look at physical prices are very high. If you look at the discounts to NAVs amongst some of the property developers and the landlords, even if you assume a cut in NAVs, they're looking very, very cheap by historical standards.
And what do you avoid?
The things that look very expensive is the consumer, and everyone's been hiding in the consumer. So any time that this whole cloud of uncertainty lifts, you're going to underperform substantially in the consumer space. We're not saying that consumers are not going to grow anymore in Asia, but the amount of growth that's embedded in share prices is too high versus other things.